let's say you have an H4 breakout, okay? So price tends to pull back and then goes down, pulls back, goes down, pulls back, goes down. Now, every time price goes down, H4 creates new levels in here. So they can be gaps, they can be A levels, they can be whatever. Whenever price pulls back, it's gonna react to one of them and then go lower, react to one of them and then go lower, okay? Now, you don't enter off of H4 alone. You have to refine that H4 level, the H1. Now, I'm gonna give you an example how to enter in here.
Folks, if you've ever wondered how to trade Malaysian SNR, now this is the video for you.
Okay, so you have to understand what Malaysian SNR is. So it's not the classic support and resistance that you guys learned from YouTube, where you have an area that rejects many times from the top, so it becomes a resistance, or it rejects many times from the bottom, so it becomes a support, and if it breaks, it becomes the opposite. No, that's not the SNR that we're going to work with. The Malaysian SNR is basically key levels. We work with key levels. So how you have to understand, how do you mark these key levels? Now we have three types of key levels. So take any two candlesticks, right, and mark the closing of the first one. So let's say you picked two same colored candles right here, which is the first type, okay, which is called the gap. Now you take the closing of the first one. Right here you have a bearish candle, so the closing of the first one is going to be right here, right? So you're gonna mark that, okay, and that is your first type of SNR. This example you have here, you have one right here that is called the gap. Now the second and the third type are called the A and the V level. I'm gonna tell you why they're called that way. So you have a bullish candlestick and then you have the bearish candlestick. Okay, so these two candlesticks represent the A level. Why? Because when you go to the line chart here, let's take an example right here. So take a look at this. So bullish candlestick, bearish candlestick. The closing of the first one is your key level. It's called the A level. Why is it called the A level? So you can go to the line chart, and the line chart helps you see the A and the V levels. Now this is giving you the shape of an A, right? This is giving you the shape of a V. So you can instantly mark a key level without actually looking at the candlestick. So this is a V level, this is a V level, right? So this is a gap, okay? Now once you understand how to mark these three types of the levels, these are the only types that exist in the market. So A, V, and the gap. So sometimes the V level gets broken in this case, so it becomes a resistance, okay? So any level that you get above the price action, the current price action, acts as a resistance. Any type of key level that you get below the current price of action acts as a support, okay? Now once you understand that, you have to look if that level, key level, is fresh or unfresh. That is known in SMC as mitigated or unmitigated, right? So I'm going to explain that. If you have a key level, right, key level right here, so let's take a gap for example, and you mark it like this. So if this gap is touched by price action, you have to identify the type of price action that went through it. So if you see a gap that went through the price, if you see a gap that is touched by a wick right here, that level is unfresh, right? But if the next price action is a body, it's still fresh, right? So if you have a wick that makes it unfresh, and then suddenly price, okay, then suddenly price breaks it again, it becomes fresh again. Okay, so let's take an example in the charts right here. So in 2 hours, okay, 2 hours, we're gonna close this candle. So if it closes like this gap right here is going to be fresh again, because here the gap was fresh, okay, and then once we wicked it, the key level became unfresh, okay? Then if we close this candle above it, it's gonna become fresh again, okay? So once you understand the fresh and unfresh, the next thing you should be looking into is the storyline, which is the direction on the higher time frame. Now, for you to understand that, there is a theory that says price travels from a fresh level to another fresh level on the higher time frame. So the higher time frame that we're going to be working with is the daily and the weekly. Some people use the monthly as well, but I'm not interested in that because it's not really that consistent for me. So let's say you have a higher time frame level on the daily. Okay, say you have a higher time frame level on the daily right here. So price is approaching that level. Okay, so if it wants to start a bearish storyline from this daily right here, where is price gonna go? It's going to go to another daily, right? It's gonna go to another daily. So on its way going to that daily, okay, it's gonna decide if it's gonna start a bullish storyline from this daily or look for another daily below it. So there are a few signs for you to know if price is going to start a storyline or not. Now I'm going to show you an example here that swing points never start from nowhere. Okay, so if you notice right here, this buy, okay, did not come from nothing. It came from a fresh key level. Now where is that fresh key level? When you look to the left, you have an A level right here that is wicked right there. So it became unfresh. And then, as we said, when price breaks it, it becomes fresh again. And then price comes to it again, and then we start our bullish storyline. Okay, now this is always the case. Now, this bullish move, where did it come from? It came from this fresh gap right here. Okay, so where did this sell come from? It became from this fresh gap, right? So it goes from a fresh level to another fresh level. So it started from here, it's reacted from there. Where? From this key level right there. So where did it start again? It started from this fresh gap right here. Okay, so it goes like that, so on, so forth. Okay, so where did this swing by start from? It started from this gap. Where did it react from here? It reacted from this A level that is hidden on the left. So when you have an A level that is hidden behind a bigger A level, it's called the QM right here. So price went lower. Okay, so how do you identify the start and the end of the storyline? Now you have few signs of the storyline to start. Now the first sign represents 5%. So it's the rejection. Okay, so when you have the rejection right here, okay, that's a sign that this key level might start a bullish storyline. Okay, now the second sign is an H4 breakout. So once you go to the H4, you would want to look at your line chart and look for an external breakout. Now that external breakout should be an A level that is created before we touch the daily. So we touch the daily right here. Now the last A level that has been touched, that has been created before we touched this key level is right here, right? This A level. Now once this key level breaks, okay, the bullish storyline starts. But there is another way to identify the start of a storyline. It's by going and waiting for one time frame lower breakout, and it doesn't have to be external, on the New York session. Okay, so some people use the H4 breakout. Most of them use the H4 breakout, but there is a faster way. Okay, so if your H4 level is way up there and you don't want to wait, you can go look for an H1 breakout on the New York session. Okay, so I'm going to give you an example right here. So when you go to the left, there is a gap right here. Okay, and that gap is still fresh until we touched it right there. Now you have the first sign, which is the rejection, and then when you go and look for an H4 breakout, the H4 breakout is way lower than that, so it's too low in here and you don't want to wait for that. So you go to the H1 looking for a New York session breakout. So here we have a breakout, and here we have another one. And at what time did this happen? So it happened at 8, 9, 10 a.m. That is in the New York session. So this gives you a mini storyline. What does a mini storyline means? So an H1 breakout doesn't mean that we're going to go to the next daily. It means we're going to go to the next H4. Now, where is the next H4? the next H4 is going to be right here. Okay, so price did not officially start a bearish storyline with daily reject daily and H4 breakout. It started a mini storyline using H1 New York session breakout. So we're gonna go to the next H4 fresh level. Now price is gonna approach that H4 next fresh level, and if it rejects it, that means we're gonna reverse from there. But if it doesn't, we're gonna go to the next one. Now once we do go to the next one, price goes up. Now how do you enter from there? How do you enter from there? Now once you have your daily, okay, let's say you have an H4 breakout, okay, so price tends to pull back and then goes down, pulls back, goes down, pulls back, goes down. Now every time price goes down, H4 creates new levels in here. So they can be gaps, they can be A levels, they can be whatever. Now whenever price pulls back, it's gonna react to one of them and then go lower, react to one of them and then go lower. Okay, now you don't enter off of H4 alone. You have to refine that H4 level to the H1. Now I'm going to give you an example how to enter in here. So price gave us an H1 breakout, okay, on the New York session, and on H4 you look for your recent fresh levels that has been created. Now in this case we have an A level right here. You would want to refine it to the H1 and take the H1 higher level in there. So price is going to pull back to that and then go lower. And you keep doing the same thing for continuation entries. Each level that gets created on the H4 can be taken as a continuation entry. Okay, so a new H4, you can take that. So you can put a stop loss of 24 pips, okay, until you reach your target. So your target is always the next daily or the next H4 if you use the H1 breakout on your session. Okay, so a new gap right there, then price goes down. Okay, you have a level right there, okay, until price reaches your target. Now once it reaches your target, price reverses. You can do the same thing. You have a V level right here, then price goes up, a gap, price goes up. Okay, just keep doing the same thing again and again right here. Okay, so yeah, the only thing that I still use from the SMC strategy is called the consequent encouragement, right? Now once you fully master all the entry types, there are few entry types, around 8 or 9 entry types. Okay, so once you fully master them, you can use what I still use from SMC, which is the consequent encouragement, to tighten my stop loss and get higher RR, and that's what I use to flip my accounts with high leverage. Okay, just have to make sure that they won't go in that much drawdown. Now once you have a daily reject daily, in this example right here, you go to the H4 looking for your breakout, right? So once you have that breakout, price tends to pull back, right? So in this case, price is going to pull back to this A level right here. So instead of selling instantly in there, when price has a big wick like this, you can go to the daily and mark your consequent encouragement. Okay, so your consequent encouragement means the 50% of this wick. Okay, I only use the consequent encouragement on the wicks. So here is your 50%, and you would want to mark that and enter there instead of entering at the A level, only if it's above the A level. But if the A level is above the 50%, you enter on the A level. So price tends to pull back to that level and reacts from it. So you can put a 7 pip stop loss there. It's originally 5, but 2 for spread. Okay, so yeah, that's all what I'm going to share with you guys today.
Hey folks, what a view behind me. I'm at Black Bull Markets headquarters here in Auckland, New Zealand. Speaking of views, you can get TradingView paid plans for free at Black Bull Markets, saving you up to $600 a year. That's right, get either the Essential, Plus or Premium plans absolutely free, and all you need to do is trade from one lot a month at Black Bull Markets. And you can also get a 100% deposit bonus for your first deposit up to $1,000. All you need to do is click the Trading Nut link in the description below.